Welcome to this second video on audit regulatory framework. I believe that you understood the first video and the concepts that are tested. The second case study will help us to look at additional concepts that makes up the regulatory framework. Like we suggested in the introductory video, by now I know you must have downloaded the case study and you've gone through them. If you've not done so, you need to pause this video first, go back to the platform, download Regulatory Framework Case 2, then take about 5 minutes to go through the question, then you come back and we continue to look at the case study together. And as you would have seen in the first video, not all the concepts that we talked about came from the case study, meaning that some of the questions tested general concepts around regulatory framework rather than bringing them directly from the case study. So, and that's the exact thing that we're going to do today. And I want to suggest that you get a pen and a jotter to take notes, because there are a few things that I'm going to say that are not on the slides that we're going to go through. So I wanted to make some notes. But let's just go straight into business and look at what is the first concept that we are dealing with today. It says, explain the external auditor's responsibilities in relation to the prevention and detection of fraud and errors. Now, like we said, that the objective of an audit is not to discover fraud. However, if any fraud or errors have occurred in the account, the audit procedure should be strong enough to unearth the fact that there is irregularity in the account with respect to fraud or errors. And there's a concept that we call material misstatement, where the financial statement does not show a true or fair view of the activities of a company. Material misstatement will arise because of two reasons: either because of fraud, which will be a deliberate misstatement, or errors, which will be an omissive misstatement. You misstated the financial statement just out of omission, not because you want to deliberately cover up your shenanigans. So now they have asked us to look at what are the duties of the external auditor with respect to prevention and detection of fraud and errors. One thing you're going to realize as we progress to audit planning and risk assessment, to internal controls, to review and reporting, is that we are going to be mentioning the standards a lot, either accounting standards or international standards on auditing. So if you hit a concept or you've been asked a question in an exams and you know that they're associated with a standard that you know, one of the ways of earning the maximum marks will be to quote a standard that is associated with the concepts that has been tested. So for ACCA 240, that is International Standard on Auditing number 240, is the standard that prescribes what will be the auditor's responsibilities with respect to, detection and prevention of fraud and error. So one of the first things you want to say is that ACCA 240 prescribe what will be the auditor's responsibilities with regards to fraud and errors. Then you now go ahead and state the following reasons, following responsibilities, which I'm going to highlight. So what will be the responsibility? Like I say, ACCA 240. This is the title: the auditor's responsibilities relating to fraud in an audit or financial statement. So one of the things that the auditor is supposed to do majorly is to obtain a reasonable assurance that the financial statement taken are free from material misstatement, whether caused by fraud or error. So if the auditor is going to be sure that the financial statements are free from material misstatement arising from fraud or error, what are the things that they need to do? What will be the responsibilities? Number one, they should identify and assess the risk of material misstatement of the financial statement due to fraud. Now, there are a lot of things that could make the financial statement be misstated with respect to fraud. When the management of the organization do not have integrity, we said that in the first video, it means that they could want to inflate figures. For instance, if you go to an organization and you find that the rules are that directors are given bonuses based on profit before tax, or they are rewarded on the basis of performance, just know that some of those things or an issue like that can incentivize directors to engage in fraudulent activities just to make the financial statement to look good. So if you find that there are things in the company or supervision is weak in certain areas, or the internal control system is not working the way it has been designed to work, or the management is overriding the internal control system, this will be indicators that the financial statement can suffer from material misstatement with respect to fraud. So you want to identify and assess. So how do you, when you have most of those circumstances I've stated, it should give you an indication that, look, this environment is prone to fraud. Then if you've identified those instances, what do? Obtain sufficient and appropriate audit evidence regarding the assessed risk of material misstatement due to fraud through designing and implementing appropriate responses. So when you go to an environment, when we get to internal controls, you're going to see, when you get to an environment and you test the internal control system and it is not working as intended, to gather sufficient and appropriate audit evidence, one of the things you do is that instead of doing what we call compliance test, which is just confirming if they are working, you've now confirmed that the internal control process is not working. The next thing to do is what we call substantive procedure, where you are going to carry out more intensive tests. For instance, if you find that the cashier takes the cash from the till and they're taking it to the bank, they took $200,000, but when it arrived at the bank, $195,000 was deposited, and there's a trace that they want to change the figure in the cash book or the other supporting documents like the pay-in slips. So one of the things that you can do is, do a more thorough check, to obtain sufficient and appropriate audit evidence. One of the ways that an organization can misstate financial statement due to fraud will be to either understate their payables or overstate their receivables. How would you obtain sufficient and appropriate audit evidence when they understate or overstate receivables and payables? You do what we call letter of secularization. In other words, you write to the creditors or you write to the receivables to confirm if they owe that amount, and then they send the response directly to you. So that would be an appropriate response. Or if you find one transaction that tested positive to fraud, then you need to do a back test and test more transactions. So that would be appropriate response to any risk that you've assessed. Respond appropriately to fraud or suspected fraud identified during the audit. So I just said it a while ago. An appropriate response to suspected fraud or fraud identified would be to back test. Like I talked about the example of the person in charge of taking the cash from the till to the bank takes $200,000, and at the end of the day, you find that in the bank statement, the deposit slip seemingly shows 200,000, but when you find the deposit in the bank statement for that day is $195,000, you don't treat that transaction as a standalone transaction. You do a back testing and then go through many other transactions to be sure that that is not a one-off transaction. And if it is not one-off, you try to identify the parties involved to unearth what has been going on. So you maintain professional skepticism throughout the audit, considering the potential for management override of controls. Now, professional skepticism is what we call professional doubt. You don't believe everything, but you doubt everything. For instance, if a company tells you that their revenue for this financial year is $300 million, to maintain professional skepticism, one of the things to do is to justify every $1 that makes up that 300 million in sales. So you need to obtain the cash receipts issued for all cash sales and confirm that they add up to the portion of the 300 million that is for cash, and then you obtain invoices issued to all the customers that bought on credit to confirm the amount that was stated as credit sales. And like I said, you can now issue letters of secularization to confirm if these customers owe this amount of money to the company. So maintaining professional skepticism like doubt would help you to question everything, and questioning everything would help you not to overlook things that should have been a clear pointer to the fact that there will be fraud or error. Ensure that the whole engagement team is aware of the risk and responsibility for fraud and error. So every member of the audit team, normally audits nowadays are planned on the basis of risk. So we call risk-based auditing. So if that is what you are doing, if you have identified areas of high risk, maybe if it is a cash-oriented company, you need to look at control over cash. If you think that inventory might be overstated, if you think that receivables may be overstated and payables might be understated, let every member of the audit team be aware that there is a chance for this, and that we as an audit company, we have the responsibility to take appropriate steps to identify fraud or error if they occur in a financial transaction. So those are the things that we need to, the responsibilities that the auditor has with respect to fraud and error. Then we now come to the case study itself. You would have gone through the case studies, but I will now highlight the key things from the content that you can see. Now, you are the audit manager of Current & Co., and you're planning the audit of Orange Financials, and they have given us key things about Orange Financial. It is a private limited liability company about to go public, and they need to attend meeting with potential investors. And the first thing they are asking is that the audit engagement partner should attend the meeting with the potential investors. And they have also asked that Current & Co., which is the audit firm which you are the audit manager, should prepare the financial statement. There's also the issue of the fact that assistant financial director who was with Orange Financials has now left and has become a partner with Courant and Co, and they are suggesting that this former finance director should be the independent review partner. Then once they are listed, they want to get an audit or a professional accountancy firm that will help them with governance procedures and other consultancy, and they are telling Courant and Co, which you are the audit manager, is interested in taking up this additional responsibility. And they say, if you want to do that, finish the audit quickly and ask us less questions. Then they are also planning to take all the members of the engagement team to a weekend away in a luxury hotel as a thank you for a job well done after they may have finished the audit and they have a good result to successfully obtain a stock exchange listing. And finally, they have offered to give a senior member of the audit team loan on a significantly reduced interest rate. So these are the key things that are arising from this case study, and they're asking you explain 6 ethical threats which may affect the independence of Courant and Co audit of Orange Financials, and they say for each threat explain how it might be reduced to an acceptable level. Now, before I ever go ahead to talk about the ethical threats, let's talk about the ethical code of conduct for professional accountants as prescribed by ACCA. Is still part of the IFA Code of Ethics for Accountants, which are adopted by ACCA. So one of those key things will be, that is where I now say you should look at you should get a hold of your pen and paper, because we would be looking at those key things. So the ethical code of conduct, the first one is integrity, which is being honest and straightforward in all business and professional dealings. There is objectivity, that says be assignment centered or act without inducing your own personal bias. So when you have an opinion to present on a financial statement, don't bring in your personal bias into it. Then there is competence and due care. For competence, members of the audit team should be appropriately trained and educated to the level that is commensurate to the kind of assignment that they are handling at a particular time. Apart from being professionally qualified, keep updating yourself by attending continued professional development to keep you abreast with current happenings in your field. And with that being said, you realize that it will keep you competent. And the due care that is added to this Code of Ethics number 3 is what we talked about professional skepticism just a while ago. Then there is confidentiality, keeping confidential the things that the information that you obtain from your client in the process of an audit. And then finally, there's what we call professional behavior, behaving in a manner that does not bring disrepute to the profession by either engaging in things like bribery and corruption, money laundering, or things like that. So these are the 5 code of ethics for members. So for this code of ethics, we now have what we call the threats, things that can make it difficult for an auditor to keep to this ethical code of conduct. The first one is what we call self-interest threats. For self-interest, when you get into an audit, there are things that might make you to compromise your objectivity. Things like if you have been promised some reward, like this, the case we've seen already, they are telling them, complete the audit quickly, and then we can give you additional responsibilities. So that is, if the auditor overthinks on the benefit they might realize if they take on additional responsibility, that might compromise their independence. That is self-interest. Then we have what we call self-review threats, where you have done a work previously and you need to come back and review the work that you have done, and you may be unwilling to say that something was wrong with the account. That is, if at all you got some issues, you got some issues wrong in the first place. Then there's what we call advocacy threats, where you need to act as an advocate to the client that you audit. And then we have I'll talk about self-review. We have familiarity threats, where because of how familiar you are with the organization or members of the organization, it might impair your independence. Then we talk about intimidation threats, where you are either intimidated because of money that is being owed you by the audit firm, or because the company you are auditing, or when you have physical intimidation. So based on the things that we have learned so far about the ethical code of conduct for professional members, and then the threats to the auditor's independence, self-interest, self-review, advocacy, intimidation, and familiarity threats. So with these things being threat to the auditor's independence, they are now asking us, based on the things that you've learned, what are the things that are threatening the independence of the auditors, that's a Current and Co., with respect to the audit of Orange Financials? The first thing that we see as a problem is that the engagement partner has been asked to attend the listing meeting with a potential investor. That is what we call advocacy threats, where you are now supposed to act as an advocate of a company that you need to audit, to tell the people that, look, this is a strong company. If you invest in it, you will not regret. You are not supposed to do that as an auditor. That is an advocacy threat. It obscures your independence and objectivity. So what is the resolution? Now, they gave us the questions in two parts. Part 1, identify. Part 2, give solution. To obtain maximum mark, just put a 2-column table. 1, identifying the threat. 2, identifying the resolution, and call this either A and B or question 1 and 2. And doing it like that in a tabular form gives you the maximum marks allocated, if the content is correct anyway. Then the second threat that we've seen is that they have asked the audit company to prepare the financial statement. This is what is called self-review threat. If they have made a mistake in the process of preparing the financial statement, then they will find it difficult to make that fact known when they are auditing the financial statement. However, let me state something, that it is the job of the auditor, the responsibility of the auditor, to express opinion on the financial statement, and it is the responsibility of the directors of the company to prepare the financial statement. For a private company like this that are not listed, the auditor can also prepare their financial statement. However, to minimize their conflict of interest, what the company should do is to use a separate team. The team that prepared the account should be different from the team that has gone to audit the account. and that would help to minimize their conflict of interest. Then the assistant finance director that left the company not long ago has been asked to be the independent review partner. This is also self-review threat. This guy has been preparing, have been working on imputing the transactions for that company until he left not long ago to become a partner in this company. So if he is coming back as the independent review partner, he is not even independent. His subjectivity is going to be obscured. So choose another person to be the review partner, not the fellow that has just left the company. Another threat associated with this kind of person would also be familiarity threat. So if he was like the person leading the audit, that's also a problem. In that case, it won't be self-review, it will be familiarity threat, because two of them is self-review and familiarity threat, because when he comes back to that place, he is familiar to the finance team and might not take a professional approach, a professional look rather, at the work. Then we talk about the audit company interested in taking on additional responsibility or providing governance oversight to the company. Two things are involved. Number one, for the taking up additional responsibility, this E is not there. The total fee income is a concept that we need to look at. It is one of the code of ethics that, look, accountants or a firm should not generate more than 15% of their income from one client. The reason is that they are going to be overly dependent on that client and might be forced to compromise just to make that client happy, since more than 15% of their annual earnings come from that client. So for them to take on that additional responsibility might mean that what the company pays them in total might be more than 15% of their annual income coming from one company. So what should the company do? Review if the total income exceeds 15% threshold, and probably recommend that the company deals with another audit firm. Then, in the same vein, with respect to their desire to take on this additional responsibility, this company has now said, if you want this job, complete the audit very quickly and ask less questions. So that's more or less like intimidation. Now money is involved. This is an intimidation threat. So if you want to complete this audit in time, ask less questions. That's intimidation threat. Then for the entire total fee audit, the total audit income, that will be self-interest threat. So what should the audit company do? Politely let the directors know that you need to comply with ISAs when you are undertaking your audit, and then you need more time to carry out your quality control procedures. So you may take as much time as you find necessary to complete the audit, rather than having to rush the audit. Then they have promised them a weekend away at a luxury hotel. That is familiarity threat. So, which can also, be self-interest threat. So they could say, okay, we finish this on time, and we do not ask a lot of questions, and we give them a good report, we are going to benefit from this. It's both familiarity and self-interest. And professionally, as auditors, we are only allowed to accept gifts that are insignificant in value. And this weekend away luxury doesn't look like it's an insignificant gift. Therefore, they should decline the offer. And then self-interest rate is coming where they are telling a senior member of the audit team that we're going to give you a short-term loan at a reduced rate. So being a senior member of the audit team, if he has the potential to receive loan at a reduced rate, what do you think would be the consequence? It would influence other members of the team to be lenient on the company if their financial transactions on their books are not adding up. So the loan must not be accepted unless it is granted in terms in line with the existing loan guidelines or rules, terms and conditions that everybody is subjected to. Then finally, you've been asked to talk about the benefits of an audit, of establishing an audit committee. The audit committee is made up of, equal numbers sometimes, or if not, sometimes not equal, of executive and non-executive directors. So for the executive directors, these are the ones involved in the day-to-day running of the company, and then the non-executive, they are appointed because of their industry experience, and they come to give their expertise to the company. So they add value to the company because of the experience that they have. So normally, the points I've highlighted here will be most of the key things that a company can benefit from if they have an audit committee. So they improve the quality of financial reporting, because they see to it that the financial statements so prepared, they comply with acceptable regulatory framework, as you've seen in the first case study. They improve the internal control environment of the company, meaning that they ensure that the internal control that have been established by the company is strong enough to prevent fraud and errors, and to ensure the integrity of the financial reporting of a company. And the non-executive directors, which I say will be the outsiders coming into the business, they will bring their outside experience. People have maybe retired judges, people who have run their own businesses as CEO and have, retired. They are brought in as non-execs, and when they come in as non-executive directors, what happens eventually is that they will bring their own expertise and experience. The finance director will be able to raise concerns with the audit committee. So normally, some operating directors of operation might get into transactions that they will want the finance director to perform one or two magic window dress to cover up, which would be unethical. What the finance director might do is to raise this concern with the audit committee, or they might want to say, look, we've been using this accounting policy, let's switch to this accounting policy, which might not be in line with international financial reporting standard. The finance director should be able to raise this with the audit committee. They will be responsible for appointing the external auditors. So if the external auditors are not appointed by the directors of the company, it adds power to the work of the external auditor. Anyway, the external auditor is appointed by the directors in the initial year of commencing a business prior to the first annual general meeting. But the appointment so made before the first annual general meeting should be ratified by the shareholders. Subsequently, the audit committee and the shareholders themselves will be actively involved in the appointment of the external auditors. They want to keep it on from the grip or the grasp of the directors, so the executive directors, so that they do not bring in their own person who would play according to their whims and caprices. And then they improve the independence of the internal auditor. The internal auditor actually reports to management or to the chief executive officer of the company, and the only lifeline they may have to improve their independence would be the support they get from the audit committee, and then they can provide advice on risk management. So these are the 7 benefits that we can derive from having an audit audit committee in a company. So the 7 that I've highlighted, you could, any other place you study for and I've seen any other benefits, you can mention that. That has brought us to the end of the second case study. We are now going to proceed to look at the case studies on audit planning and risk assessment. So see you in the next video. Thank you.